Hey guys, welcome back to the channel. It's been a minute since I did a video. I think the last video I did on my portfolio was a few weeks old. So in this video, I'm going to go through all the new changes that have happened in the portfolio. I'm going to go through the individual stocks that I own and the thesis behind them and any news attached to them in the past few weeks. And just to go over some housekeeping things, I'm now recording my videos through Substack, and that gets automatically published to YouTube and LinkedIn and things like that. So allows me to consolidate all my content in one spot, which is going to be Substack for all my existing members and any prospective members. Find me on Substack and join me. You get so much information and valuable insight on the market, and Substack is where it's going to be. And another thing is I use stock analysis for all of my stock analysis needs. So if you want to join that, there's a discount code BEARD and you get 10% off when you check out. So just a few housekeeping things. But if you like this content, please like and subscribe. And let's get straight into sharing my screen about my new portfolio. There's stocks and ETFs now. So I'll describe that, why, thinking behind it, once we get into it. So let me share my screen. And I'm obviously using stock analysis now for all of this. And you can see that I've imported my watch list into stock analysis. I've imported my my brokerage account. I've imported my brokerage account into stock analysis, and it's really great because in the watch list section, I've imported my brokerage account into stock analysis, and I'm using the pro version, and you get so much value from the pro version. But here is my holdings. I have AMR, Celsius, Meta, HCC, Google as my individual stocks. And what's new on this list from the last update, from the last video, is 3 ETFs that I've added. IAUI, which is a gold covered call ETF. SCHD, which is a very common ETF based on dividend growth. And QQQI, which is another covered call ETF that covers the NASDAQ. And I'll get into each of these in their due turn and explain why I chose these to invest in alongside my concentrated stock holding positions. So if we start with, let's say, AMR, and here you can see all this information in stock analysis, but AMR has been going on a rip higher. Right now it's at $195.2 per share. And recently it was down all the way down to, let's see, in the last month, it went down to 137. So literally it has gone up $60 per share within the last month, the last few days, honestly. So that's crazy growth. And why it got down to 137 in the first place is because of their DTA terminal damage. They announced that they had to do force majeure for a lot of their customers because one of their stacker reclaimers, which loads the coal onto the thing to get it to their customers, was damaged. They have 2 of them. And so the other one was not damaged and they are still operating normally. But that news sent the shares down lower. Some weakness in the earnings that they reported. They reported a loss, and they and that together with the news of the DTA terminal damage lowered their stock price, and people sold, and it got down to 137 in the past month. But since then, since the earnings and post earnings and post that news, even though we're waiting on more news to show up for the DTA terminal damage, they have been going on a tear up. And I think that's due to several factors, including, strengthening met coal prices, strengthening steel demand, but not so much to account for this type of increase. I think it's more just this sector being more, I think it's more the sector just recovering a little bit from the doldrums and just an overselling of this name, really. And that's what led to this increase. And what an increase it was. I didn't expect it to be such a high rebound, but wow, it really came back up. And my average cost, as you saw on my watch list, is around, 176.18 per share. So now I'm sitting on a nice gain of $3,618 so far. So total percentage loss is positive 10.82%. And I was going to add more shares. I was adding aggressively as I could when it went down to 137, but I would have loved to added more at that time. But now it's over my cost basis, so I'm probably going to slow down or eliminate any additional shares right now, unless there's another dip into in those levels. So going back to this, the next stock on here that I want to talk about is Celsius. And Celsius is an interesting stock. I bought a lot of my shares at like 28.5 cost basis, dollars per share cost basis. But then I bought 200 shares at 33.8, thinking that it was breaking out. So what I managed to end up doing is just, averaging out my cost basis to about 30. I think it's about 29.299. I think my average cost is around $29.99 per share for this. So now I'm sitting on a nice gain on this too. And if you get a look at my watch list here, it's about $2,000 profit. Both AMR and Celsius were down, almost $10,000 together, but now they're both up about $5,000, $6,000. So that's really nice to see especially in 1 month time change, which is kind of crazy for the length of time that I invest years out. It's crazy to see big jumps like this in less than a month. But Celsius is interesting. They had some weakness around the name. It's continually weak because there is a investigation into some of their drinks about, children drinking their drinks and getting sick and things like that due to the high caffeine count or high caffeine amount in some of their drinks. And I think they're just mitigating all of this stuff. Their earnings were a little, on just level, nothing spectacular, but just level. CEO came out and said stuff about weakness and things like it was supposed to be better, more forward at this point in time, but it's going to take another quarter to get to the level that they mentioned previously. So things like that have kept this stock weak, but they still have fundamental tailwinds for their company. They still have huge international growth opportunities, and they've only slowly started scratching the surface on that international approach. So they're now in Europe a little bit and doing that, but I think they still have a long runway of growth to occur. And if you look at Monster for any of those companies, they have a market cap of, let's see here, market cap of $92.93 billion. And Celsius has a market cap of 8.18, even with the rise recently, $billion. So for this, I think this does have the potential to catch up to Monster and Red Bull and names like that. But that would be like a 10x from the current prices over time. So I'm very optimistic in Celsius. I think over time, long term, it has the ability to be over $100 per share, if not more. If they do the international expansion correctly, if they are able to answer this litigation appropriately and settle, I think they'll be able to keep growing and really show the potential for this company. Going back to this, now let's move to Meta. Meta is also showing a lot of weakness recently. They're also in their own legal battles, according to, a lot of states are suing Meta for, social media and young children being addicted to their social media. And Meta is kind of the poster child for social media, even though other big tech have social media platforms. Meta is the primary one. And so they're kind of the punching bag for all of these litigations and all these states suing Meta for this particular thing for social media. I think three things need to change for Meta for them to be, in the thousands, maybe 1,500 price tag for their stock. And those three things are obviously an end to the litigation with the social media and young children case. That needs to come to an end or be settled reasonably without losing too much market cap and too much cash for the settling of that case. The other thing is they need to stop increasing their capex spend and maybe plateau that capex spend so that they can, start realizing the free cash flow. So they can start realizing that free cash flow that they make is so much free cash flow, but it's depressed now because of all that AI capex spend. So once they are able to plateau or investors see that they're not going to be spending $50, $100 billion more every year or every 2 years, once they see that, they'll be like, okay, Meta's turning into a cash cow again, and I can start investing my money into it, and it's a safe play. But until those things happen, I think Meta is going to be in the doldrums, unfortunately. And the third thing that I want to mention is they need to see a scaling of their cloud business. The cloud business they kind of recently hinted at and kind of started. That needs to really grow and compete with, Microsoft, Amazon, and Google. And so they need to become the fourth major player within those four companies to improve their cloud and offer cloud compute to their customers. Because if they can do that, they can show resiliency beyond their advertising, which is like 99 or 98% of their revenues by segment is coming from advertising. So they need to diversify that, just like the other hyperscalers are doing that. The other hyperscalers, Google, Amazon, they have advertising businesses. Microsoft have advertising businesses, but they have so many other things that are in the hopper, so many other business verticals that they can count on to support that AI capex. And even they are getting hit by increases in AI capex and going into debt. So Meta needs to slow down on the AI capex, finish the litigation. They need to get rid of Reality Labs, losing them billions of dollars, which they can't afford to spend for right now when they're ramping up their AI spend so much. They need to get rid of that. They need to start showing free cash flow increases rather than decreases, slow down on debt, stop taking on debt. And I think this company could easily be $1,000, $1,500, $2,000 if all of those things happened. Now, will those things happen? I'm not sure. It's a toss-up because they still need to compete with other hyperscalers and other companies that are spending billions and billions of dollars on AI capex, data centers, all this stuff. So I'm not sure if all of these will come to fruition, but if they did, this could be easily $1,000, $1,500, $2,000 stock. And right now, my position in Meta is down, not by much, only like $183, but, and I only have 26 shares of it. I would like to increase my shares in Meta at this depressed price. And I'm foreseeing that at some point in the future, maybe years into the future, they will have all those things that I mentioned going for them and their price will go up. But this is a long-term play, obviously, as all the other ones are as well. Now, HCC, that's doing great. Just recently, just like AMR, it was down in the doldrums. It reached down to $80 per share. And I didn't add any here because my cost basis is around 49 for 500 shares. So I didn't really feel like I needed to add any more while I'm increasing my cost basis. So I didn't want to do that. But this would have been a great position for somebody starting out position in HCC around $80 per share. Now it's at $105 per share. And HCC is unique, even in terms of its comparison to AMR, because their cost efficiency is through the roof. They are able to load coal onto barges and send the coal out to their customers through the port of Mobile, Alabama. And so because of that, because they're not solely relying on railroads and the rail providers, they can reduce their cost per short ton of met coal a lot more than things like AMR, companies like AMR and other companies like that, that rely solely on rail to get their coal to the port or to their customers. So because of that, they're able to capture a higher degree of margin from every short ton that they sell. And that's why when you see AMR dropping, $60, $70 met coal, because of their met coal margins, HCC only dropped $20 from 110 to, 80, 85. And so now, and they're right back up because they're one of the most cost efficient met coal miners out there. So I'm not doing anything with these shares right now. I'm not going to be buying anything, but I'm definitely not selling anything. This is a 5 to 10 year position for me, and I fully expect this to be maybe $200, $300 by that time if they can do a combination of massive free cash flow increases and either buybacks or ideally buybacks, but worst case buybacks and dividends, special dividends, something like that. With that, over 5 to 10 years, the compounding in this name should be quite good. And I do expect it to be either, double this price or even triple this price in 10 years. So I'm going to be holding on to these shares and seeing that appreciation come through. And right now on my watch list, you can see that I have 500 shares, close to 500 shares at 49.3 average price, dollars per share average price. About a $52,000 position. It's up 112% for me, and I'm doing about 27 to 30,000 in profit for that position. Really good. This is my best position in my portfolio. Then Google, as the last one of my single stock, my individual stocks. Google is up and down. It's pretty steady Eddie here. Over $4 trillion market cap. There's not much you can say about Google. They have so many different business verticals that it's pretty hard to disrupt them. They're considered one of the leaders in AI and AI models with Gemini, and they've successfully integrated AI, I think, in a lot of their products, including search, including, all these other things, YouTube, all of those products, they have pretty much integrated AI into. So they are doing incredibly well. And if I saw a huge decrease in here, I would definitely be picking up some more Google shares. But right now, it's not at a point where I think a huge discount to where I want it to be. I want it to drop maybe sub 300 if that was even possible. And I would pick up a lot of shares of this going forward. Their recent earnings happened and they were incredible, honestly. So A++ income statement, balance sheet, and cash flow statement. The one thing that does worry me is that they're taking on debt and reducing their free cash flow in the short term to spend on AI capex. And just like the other hyperscalers and tech companies that are doing that, I'm not really a fan of that because that reduces the free cash flow that can be returned to shareholders like me. And so that's not great. But that's the only blemish I can see on this company. Otherwise, it's doing great, and I would still buy a ton of shares, even if they were doing that. If it dropped maybe like $30, $37 per share, I would definitely get it. Looking at my watch list here, and I have about 61 shares here, and my average price for that is 158.9. So another thing that wouldn't be great is I would be, averaging up at 300, even 300, or even slightly below 300. So I definitely want to see a nice drop on this before I start, buying more. And just like HCC, I'm 112% on these shares. I have less shares, so I'm only up $10,000, $11,000 nominally on that. Now, let's get to the 3 ETFs that I bought. And the first one is IAUI. And like I said before, IAUI is a gold covered call ETF. Now, you may be thinking, why am I buying covered call ETFs when I'm really touting, individual stocks and concentrating individual stocks for compounding and high quality for years into the future? Well, the reason is IAUI and QQQI are both from an ETF provider called Neos. And Neos has created some ETF products that are really unique in terms of tax advantages. So usually a traditional covered call ETF runs a covered call strategy on their asset base, and the income that is distributed monthly to their shareholders is considered taxable as ordinary income. And the problem with that is taxed short term, and it is taxed at a higher rate because it's ordinary income, not qualified dividends like SCHD provides qualified dividend income. It's not like that because it's an active strategy. They don't consider it qualified dividends. So because of that, the tax implications are super high. Not to mention the expense ratio with those covered call ETFs is also higher than SCHD, which is very, very minimal. So those two combined, it makes it really not worth investing in a covered call ETF strategy unless it's in your Roth IRA, your 401k, some type of HSA, some type of tax advantage account. So I always steer clear of them, even though I knew a lot about covered call ETFs and covered call options and options in general. But I just steered away because of their tax disadvantages. So enter IAUI and QQQI. Now, these are very unique for a few reasons. The first reason is they run covered calls on indices. And when you do that, the IRS treats that income as Section 1256 income. Basically, it's treated as 60% long-term gains and 40% short-term. So it's not all 100% short-term gains. So that's the first tax advantage that shareholders of these Neos ETFs get. But the more important one is ROC distributions. So the distributions are majority considered like 80, 90, even close to 100% considered ROC, return of capital distributions to the shareholders. What this means is those distributions are not taxed within that tax year. They are only taxed if you sell your positions, sell your shares, and then they're taxed. Instead, those distributions are counted against your cost basis. So they lower your cost basis every time you get a distribution. So the IRS is keeping tabs on your distributions, but they just don't tax them until you sell your shares. So if you can technically never sell your shares, and the amount of distributions you get reduces your cost basis to zero on these shares. And if that happens, any future distribution gets treated as long-term capital gains. And long-term capital gains is treated, as we know, at the higher end at 15 or 20%. And long-term capital gains is taxed at the highest end at max 20%. So literally, you have so many factors that are working for you in these type of ETFs, in these specific covered call ETFs. And I chose IAUI because they are a gold high income ETF. So I wanted to diversify into commodities, make sure I have covered that section. And then the other one is QQQI, and that is the NASDAQ 100 high income ETF. So I wanted to hit technology with the covered call ETFs because it has high appreciation, which won't be totally capped because they do out of the money calls, covered calls. So that gives that little bit of leeway in capturing the upside. And gold, which is, been here for 5,000, 6,000 years. It's not going away. It's only going to grow into the future, especially with inflation, with the national debt being over 40 trillion now. So all of those things made me go into those. And the final one is SCHD. And this is the Schwab US Dividend Equity ETF. This is a really, really good ETF as a backbone for this portfolio. Because what it does and what it allows you to do is get high quality compounding companies, a basket of them, and have their dividends increase every year. This ETF holds companies that have dividend appreciation stocks within them, and they rebalance it every year so that you have the maximum dividend appreciation in this account. So it may be doing 3% nominally right now, but it could be doing 7% in 10 years or 10 years because it continuously increases, looking for stocks that increase their dividend. And that is really cool because, and also those dividends are considered qualified dividends. So the tax treatment is very favorable with a very, very low expense ratio. So this is like my backbone ETF to counterbalance the gold covered call ETF and the NASDAQ covered call ETF. It's like the glue that holds everything together and allows me to get more margin buying power and run other strategies within this portfolio, which I will go into later in another video. So those are my positions right now. And you can see that it is working pretty well in this type of barbell, balanced, diversified approach where I'm making huge amounts of money on, HCC, Google, AMR and Celsius are now positive. IAUI and SCHD are now also positive. And since I started this maybe like 2 weeks ago, QQQI is still negative and META is still negative, but those things I have almost 100% faith, not financial advice, but 100% faith that they will increase into the future. So my total portfolio value is 186, 187,000, depending on when you look at it. So far, I did take some money out for, other reasons to pay for some lifestyle things. But overall, this portfolio is growing nicely, I think. And this is the type of format that I'm going to have in the future with my portfolio updates, going through stock analysis and looking at all of this stuff. And I do imagine my dividend yield growing as I add to QQI, SCHD, and IAUI. Hopefully I can get my PE ratio down a little bit for the overall portfolio and the dividend yield higher, closer to 5-10%, depending on how much money I can get into these things over time. So the growth stocks will feed the dividend appreciation and dividend covered call ETFs, and those will feed any individual stock purchases or analysis that I do in the future. So it's kind of like a virtuous cycle that I've set up. And that's the main high level concept that I'm trying to pass on to you guys, is what I'm trying to do here. I haven't given up on growth. I haven't given up on growth stocks, individual growth stocks, and I haven't given up on cash flow and income. I'm actually combining both of those to create a virtuous cycle where I can invest in what I want and get growth where I want. So that's the idea, guys. If you like this content, please like and subscribe, and make sure you check out the link to stock analysis. I have the code down below. It's Beard. And when you check out, 10% off. It's really great. In some other videos, I'll go through some of the features that stock analysis has. They got stocks, and you can do a stock screener, stock exchanges, comparison, earnings calendar, industry. It's so much stuff. Corporate actions, IPOs, huge thing. You know, some of these IPOs that came out this year, SpaceX and some other ones that are going to come out, you can see when they're going to come out, like what IPO price is probably going to happen, the return on some of those. So it's really useful. Some of these other smaller companies you don't even know about, and you can find them all here in the IPO section. ETFs, it actually has an ETF screener comparison tool. So those ETFs that I mentioned earlier, you can screen them, compare them, see what their expense ratios are, what their dividend yields are, what they hold, and who the providers are. Those are huge things when you're trying to research ETFs, and if you want them in your portfolio, this is crucial information for that stuff. But yeah, so much other stuff that I'll get into other videos in a dedicated video about this. But yeah, thanks guys for sticking with me, and hopefully I can get a video out every week from now on, going through Substack, and join me there. Like if you're wondering where you can connect with Bearded Investor, Substack is the place to be. All right, guys. See you in the next one. Bye.